Good day. Welcome to Chapter 2, Lecture 2. In this lecture, we will be focusing on Objective 2. Objective 2, identify and apply basic cost behavior patterns. Fixed versus variable costs. Fixed costs, these are costs which are unchanged in total regardless of production volume. They are difficult to alter in the short run, for example, rent, insurance, and administrative salaries. Variable costs, these are costs that change in total based on production volume. Typically can be altered in the short run. Examples are production wages, electricity, and the materials used in production. Let us consider the following example, which demonstrates the effect of changes in activity level on unit costs and total costs. Ocean Breeze Hotel has fixed costs of 2,000 Rand per month and variable costs of 5 Rand per room. In the first column, we assume a certain number of rooms is rented out per month, 0, 60, 85, and 100. Fixed costs per month will not change irrespective of the number of rooms that are rented out. The variable cost per month will change depending on the number of rooms rented out. If 60 rooms are rented out, total variable costs will be 5 Rand times 60 equal to 300 Rand. And the total cost will be the fixed cost of 2,000 Rand plus the variable cost of 3,000 Rand equal to 2,300 Rand. Graphical representation of costs. The fixed cost line, the variable cost line, and the total cost line. In this graph, we measure price on the vertical axis and the number of units on the horizontal axis. The total fixed cost at 2,000 Rand remains unchanged irrespective of the number of rooms that are let out. Variable cost changes in direct proportion to the number of rooms that are let out, and total cost is the sum of the variable cost and the fixed cost. Average fixed costs and average variable costs. Average fixed costs is equal to total fixed costs divided by the total number of units produced. Average variable cost is equal to total variable costs divided by total number of units produced. Let us consider this example of a company that manufactures t-shirts. The monthly rental is 1,000 Rand, and this company may produce either 200, 400, or 600 t-shirts a month. The average rent cost per t-shirt works out to 1,000 divided by 200 is equal to 5 Rand. If we increase the production to 400 units, the average cost declines to 2.50 Rand. 1,000 divided by 400 is equal to 2.50 Rand. So each time we increase production, the average rent cost decreases per unit of production. The variable cost for manufacturing these t-shirts is 15 cents per unit. So if 2,000 units are produced, 2,000 times 15 is equal to a total variable cost of 300 Rand. The average variable cost will be the total variable cost divided by the number of units produced equal to 15 cents per unit. So average variable cost is constant per unit as opposed to average fixed cost per unit, which declines as the number of units produced increases. Mixed cost. A mixed cost is one that contains both a fixed and a variable component. Only the variable portion of the cost can be altered in the short run. An example of a mixed cost is the monthly cost of a copier. The copier has two cost components, a monthly lease, which is fixed, plus a usage cost per copy. So the number of copies that are made during the month times the usage cost per copy will give you the total variable cost for the month. There are several estimation techniques to estimate the fixed and variable components of a mixed cost. These are the scatter graph approach, the high-low method, and the linear regression approach. This diagram is a representation of a mixed cost. It goes back to the original hotel example, which has a fixed cost of 2,000 Rand per month plus a variable cost of 5 Rand per room rented out. So total variable cost is equal to the number of rooms rented out times the variable cost per unit, and total cost is the sum of the fixed cost and the total variable cost. So this line here, the total cost line, has both a fixed and a variable component in it and is therefore a mixed cost. Step costs. A step cost is one that does not change for set levels of production but will change at specific points. Only the variable portion of a step cost can be altered in the short run. An example, for each 100,000 additional units produced, another supervisor must be added at a salary of 75,000 Rand per annum. So this represents the increase in the total cost after 100,000 units have been produced. The first 100,000 units, then we need to add a supervisor and the cost goes up by 75,000. Then it remains stable until another 100,000 units are produced when the cost goes up again. So this is a step cost. Product costs versus period costs. Product costs, these are costs that are associated with the acquisition or production of goods and products. Product costs are an asset until the products are sold, when they are transferred to cost of goods sold. Period costs, these are expenses that are not product costs, such as selling and admin expenses, and they are expensed in the period in which they occur. This is a journal entry for cost of goods sold. Product costs are accumulated in the finished goods inventory account, and when the products are sold, the debit is charged to the cost of goods sold account and the amount is credited to finished goods inventory. Insurance prepaid. Assume a company pays 10,800 Rand insurance at the beginning of the financial year for the entire year. Since that amount is prepaid, the initial debit of 10,800 Rand will be made to prepaid insurance. During the course of the year, 900 Rand per month will then be charged as an expense to insurance expense and credited to prepaid insurance. This is an example of a period cost, which is charged as an expense over the period to which it relates. Prime costs versus conversion costs. Prime costs, these are costs that are directly associated with the production of a product. Examples are direct materials and direct labor. Conversion costs, costs that are necessary to convert raw materials to a finished product. And the two main components of conversion costs are direct labor and manufacturing overhead. This table summarizes the categorization of different expenses. For example, rent on the production facility will normally be a fixed cost. It will also be a part of product cost because it forms part of manufacturing overhead. And since it forms part of overhead, it will also be a conversion cost. So a particular expense will have more than one categorization. That brings us to the end of Chapter 2, Lecture 2. Thank you.